Greetings of the day. The paper I am presenting today is International Subsidiary Performance of Indian Multinationals in the Extractive Sector, the Role of Institutional Quality, Corruption, and Investment Regime. So the paper is published in Resources Policy. Along with my co-author, I have written it from BIMTech, and the journal has site score above 5. The motivation of doing this research was kind of twofold. One is that in previous studies of outward foreign direct investment from India, there were emphasis predominantly on the market seeking motive and using aggregate data or the macroeconomic data. Such claims were supported in the sense that investments were going to countries where there were higher per capita income, as it can be inferred from there that investment is going to places where there is a market. However, this was contested in one of my previous paper, what motivates Indian firms to invest abroad, in which firm level data supported the presence of multiple motives. So along that line, there were further gaps. For example, when it comes to extractive sector, so I'm coming to the second point by way of motivation. So most research finds that investment made by, say, the Chinese companies are driven by resource seeking motive, and there are many papers on that. So I was kind of looking at the Indian data, and I was not convinced with the earlier argument that market is the dominant reason for making investments abroad. So I found a lot of investments in the extractive sector as well. So taking that query forward, try to explore how much investments, how many firms have invested in extractive sectors. So I try to gather some data on that, and based on that foundation, formulated certain testable hypotheses, and then went ahead with this paper. And so this contributes to the limited discussion on resource seeking motive by Indian firms, or for that matter for emerging market firms, and explores a question about the performance, because having made the investment is not enough. From the developing countries, when the firms go out with a capital, it means there is lesser investment in the domestic economy. So unless those capital invested abroad is able to generate return, that's not helpful from the country point of view. So therefore the question of examining performance is in that context, that if they perform, why do they perform? So that will help deciding, or making decisions about location of investments, especially in the resource based sectors. So the point is that capital scarce developing countries like India, which tries to attract a lot of foreign direct investment into the country, also experiences outflow of investment. And to justify that, to justify the outward FDI policy especially, we must see that firms perform. And therefore, it's important to understand what drives the firm performance abroad. So in the specific context of extractive industry, the paper, brings up certain, findings, which I'll explore. And finally, uh, we also see research seeking motive, even in the case of India, to say the least. And uh, of course, data suggests that, as well as we know it from the fact that in certain products there is export duty, which is not the case in other sectors. You don't tax the exporter when they export, but you do so when it comes to metals and products like that. So therefore this is uh, the kind of platform or foundation or motivation based on which the study has been conducted. Now I'll move a little faster, uh, and therefore we'll show some hypotheses and data and methods, and then discuss the findings. So here are certain examples. Reliance Industries investing in these African countries in the oil sector. Gapco, especially, it was well-known example, and I'll not give further details here for sake of time, but here is another interesting story which I can tell later. Similarly, say we can see Hindalco. All right, so they have many subsidiaries abroad, and why would they go for acquiring or investing in such subsidiaries unless they want to get access to resource? So that's something clearly visible from the data. And being scarce in certain resources, a growing economy always needs to find a source or supply of those resources from other countries, just like China does. So the reserve of many resources are not here in India, be it copper, lithium, or cobalt. Majority of reserves are in other countries. And of course, we know about things, examples like rare earth elements. These are just to substantiate my claims, and even the right manganese and so on. So there is clear need of investing abroad, but then also need to perform. The investment need to give good performance. So therefore, in this study, to cut the literature short, I have taken that slide out, but straight away going to the hypothesis, basically try to test whether better institutional quality in the host country positively impacts performance of subsidiaries or not. Similarly, resource sectors are well known for corruption. So what role does corruption play? Then investment regime in the host country, does it play a role in performance? Then is it driven by economic growth in the host country? Host is the destination country, and also having resource in the host country, does it guarantee good performance? So these are some of the hypotheses we test by using panel data, econometric methods. And the industries covered in the study are these, which include manufacture of metallic, non-metallic mineral products, basic iron and steel, precious and non-ferrous metal, casting, and so on. So these are the 6 3-digit codes, industry codes in our sample. So basically, it's a dynamic panel data model where you try to see what impacts performance. So profitability of the subsidiary as a percentage of asset is the dependent variable, and the lag of the dependent variable is also included, just to look at the path dependence, that if I perform good last year, it's likely that I perform good this year as well. And then you control for a host of other variables, and those variables are taken from the hypothesis. So we have institutional quality, corruption, then you have GDP growth, reserve of ores and minerals in the country, foreign direct investment, stock as a percentage of GDP, as well as subsidiary specific variables and firm specific variables, which are rarely found in many studies, because unless we control for all these factors, we might get some erroneous results. So we have 3 sets of variables here: country specific, firm specific, and subsidiary specific. Now data, so it's the hard part. So usually you don't get subsidiary specific data in required format. So I must say here that the segment here you can see from the annual report. For example, this is a company called Electro Steel. Their foreign subsidiary are these, and you can see profit after tax right here, and also you can see the assets and turnover and capital and so on. So using this information, we compile this in a required format uh, for the purpose of analysis. And you can see many are earning negative profit as well. So this data has been collected quite manually for more than 150 subsidiaries. Uh, and let's briefly talk about the institutional quality. How do we measure it? And there are many ways to talk about institutions, but in this study, we use the world governance indicators. There are 6 indicators, and since they could be correlated, using all of them in the regression is not advisable, and that is some other point which will be explained in subsequent slides about multicollinearity, but we don't use all 6 in the regression as independent 6 variables. We combine 6 indicators into one using a method which is basically indexing method, using entropy principles. So firstly you convert into a dimension index, then standardize, and then calculate the entropy. Basically this to reduce the skewness and all. You have seen logs and all here, and then you generate weights, and using the weights, and each 6 dimensions get a weight, and then combine into a IQ score, and that helps us arrive at one particular score of institutional quality. Now we have other variables. Corruption perception index comes from Transparency International, then FDI stock GDP ratio comes from World Investment Report, annual World Development Indicators, and the sources of other data are World Development Indicators, annual reports, and CMI sources. And the hypothesis is that IQ should have positive impact on performance. Corruption could be having a positive impact. Not sure. We'll see how it is. FDI stock GDP means more competition and so on. So it might reduce performance. Growth should improve, and the stock of minerals should improve performance. Now here are the descriptives. Final sample had 150 subsidiaries, 823 observations, and these are the mean and standard deviations. Now results. This is the full table, but you might not see all of it. So I have taken out subsidiary specific and firm specific variables here, and you can see institutional quality has positive significant impact, and corruption is kind of negative. FDI stock negative means competition means more, losses, and growth actually does not improve performance. This is looking contradictory, but it is not. So I could convince the reviewer that it's a extractive sector. You don't go by market seeking, you are going by research seeking. So host country growth, you are not having a aim of selling it in the host country. So how does it matter if it doesn't grow? The host economy, even if it doesn't grow, you might do well. But that's the argument that the resource sector is different, or the extractive sector is different. It's not the driven investment is not, or performance is not driven by economic growth in the host country, and positive impact of ores and mineral stock. And basically econometric properties are well satisfied. AR1 is significant, AR2 is non-significant, which should be the case in dynamic panel, that you should have first order correlation present and second order correlation absent. And why I have put column 6 and 7 in red is because the initial version of the manuscript included column 1 to 5 only, then 6 and 7 were added after the reviewer comments. And what is the major comment? There are many, but I'm just showing one so that I can tell you what went behind it. And one of the comment was that GDP and GDP per capita, that means GDP per capita and GDP growth are likely to be correlated. That's the hunch of the reviewer. But later we have shown in the revision that that was not the case. The VIF were below 10. However, this was found to be above 10 in the case of two variables, which are IQ, because there is a component of corruption, and this Transparency International Corruption Perception Index. So which was not pointed out by reviewer, but we found it, and we could have said that there is no serious multicollinearity, so we could have given them 1 to 5 only, but we added 2 more columns showing that we found this in the case of IQ and CPI, and added 2 columns by dropping 1 in column 6, IQ was dropped, and column 7, TI CPI was dropped. So this was beyond what they asked, and after the revision, the paper was accepted. So just want to make the point that sometimes it's necessary you know give the best reply, which we did in this paper. Okay, so, and also we did robustness 6, excluding the offshore financial center subsidiaries, and consistent results. So therefore, towards conclusion, we must you must have seen, and here is the highlight. emerging multinationals in the extractive sector has resource seeking motive for sure, and better institutional quality improves performance, which is a quite strong finding. And it also helps in attracting FDI flows, right? But the less competitive investment regime tend to improve performance in this sample means where other investors are not investing, it was found to lead to better performance, which suggests that Indian multinationals in this sector are doing well in places where competition is lower. So that might be one point, that improve the competitiveness so that you can perform better even in other location where there are a higher competition. So that's clearly suggested in the paper. And GDP growth does not matter. Even this we could convince, and intuitively makes sense, because you are not extracting the resource to sell in the host country. So that's briefly our major findings. And going beyond these, there are other papers that uses or test other sector related issues. So we could especially just to mention in the end a few other papers which explores international investment related issues for Indian multinationals are in the software services, especially the closure. Closure is the extreme event. Even if you don't perform okay, but you close means you're out of the business in that location. So that was explored. And specific to China, what determines survival was also studied using subsidiary level data, which are very limited because of the lack of data, but some hard work went behind it to collect certain information in an unconventional way that helped us to build these papers, and also location of subsidiaries in China. So uh, to conclude, all these papers uses some sort of econometric analysis. Of course, that's not the driving point, but tested certain important hypotheses, or derived certain important equations, and which were tested. And results were quite logically understandable. So therefore certain success in getting these papers published. And I must say it's a continuous process. I don't want to say how long it takes and so on, but you need continuity, resource, support, and if that lacks, it takes more time. And uh, that's something one must emphasize if research output needs to come out. And thank you for your attention, and would look forward to interact further. Thank you.